Welcome back, and joining me now for a look at the equity space is Cremen from Adviceworx. Caroline, thank you so much for joining us today. Now, volatility has been the name of the game when it comes to markets this month, as policymakers warned of less aggressive rate cuts, which sort of dashed investors' hopes, right, Caroline? But towards the end of the week, we started seeing a turn of events with some positivity coming through into markets. Is this just a relief rally, Caroline?
I think you can probably call it that. I don't think there's enough data in the market for this year yet. We still got the Fed meeting at the end of the year. I tend to disagree, that markets kind of misread, kind of thought that the Fed and other central banks were going to be a little bit more benign this year. I think most central banks were kind of clear that they were going to really keep an eye on inflation, that possibly those cuts were more likely to happen in the second half of 2024 as opposed to, as early as March. Some people were predicting after they saw some of the figures last year, so there was room for disappointment. I think people have come to the realization now that that's, first quarter, very, very unlikely. Second quarter, a possibility. I think people are kind of coming to terms with that if that does happen, it's going to be towards the end of the second quarter. But right now, too much really pivotal news driving the market. So you're going to see things go from here to here to here, just depending as, really as news flow comes in.
We're just crossing fingers for those rate cuts so we can experience some relief on all ends. Now, it's been a busy week, Caroline, with investors digesting commentary out from the Fed, economic data, as well as earnings season heating up. I want us to start off with those company results that have been released. We've seen somewhat downbeat numbers from the US banks, but there was some relief with positive numbers from TSMC, which then boosted those tech counters. I know earnings season is just starting off, it's just heating up, but what have you made of the numbers that we've currently seen?
So they're very interesting because it's actually an interesting period of time. So in a time like this, it's definitely a stock picker's market because people, not all companies are going to perform the same. We saw that particularly in the banking sector, where some banks did really badly and some banks actually did, quite well. It's fair to say that, they're going to downplay earnings for the rest of the year, especially if the Fed starts to decrease interest rates, that obviously may have an impact on their earnings. But I think what surprised me about some of those results was how badly some of those banks actually did. Notably the investment banks, and how well some of the banks actually did as well. I think from a company like Taiwan Semiconductors, yes, in this particular market, when you see things like NVIDIA and AMD start to jump, obviously that type of company is going to do well as well. And, that goes, and it just shows that theme that we had last year, where you had those very few tech companies that did extremely well. And others that were kind of so did have a bit of a recovery but didn't do as well, is probably going to continue this year. This is definitely a market for winners and strong companies. We're not in that situation that we were in 2, 3, 4, 5 years ago, where a rising tide raises all ships. Some ships are going to be left at the bottom of the harbor, unfortunately. And as interest rates are not probably going to be, decreased really fast, they're going to be left at the bottom of the harbor. So it's going to be an interesting year, because it's going to sort out the sissies and the really, really strong guys.
You're right. It'll be definitely interesting to see how this earnings season also just plays out and the numbers we continue to get. Let's just focus now to those economic releases. There was a retail sales print from a number of countries. Out in the US, sales jumped 5.6% year on year in December, which was above analyst expectations. A sour picture played out in the UK. Today I saw numbers were out and sales fell 2.4% in the same period, further showing that, those consumers are still feeling the pressure. Now, that economy has been reeling, Caroline, dealing with internal issues as well as what's been happening in the global environment. What's your sentiment around the UK, especially as we're heading into that rate cutting environment?
Well, two things. First of all, Europe and UK in particular, they're harder hit by inflation than the US, on the oil price front, on the food side. So one would actually anticipate that would actually happen. The other thing is what is actually going to happen with inflationary pressures and rate cuts going forward? Because I think I saw the initial comment was, well, the sales were so weak, that it kind of raises hopes that, the central bank in the bank, will actually decrease rates faster. And now that's fine unless you have more inflationary pressures. And I think one of those things we do need to keep an eye on is really what is happening in the Red Sea, because, this is your main transport route into Europe and out of Europe. But mainly for European economies, it's going to have an impact in Europe, especially if things, they start to pay more things because they've got to come around the Cape, and if there's supply interruptions. So you've got this outside event that could really derail that softening of inflation thesis that is technically going to lead to lower rates. So I think Europe is going to be a difficult time for the whole really the whole continent, especially over the first 6 months of this year. And I wouldn't be putting too much faith in the fact that any of those central banks is going to be decreasing interest rates in a hurry. And even in the US, I mean, one of the Fed officials came out earlier in this week and he said, look, that he spoke about unpredictable events globally. And I think this is going to become more of a factor this year. And even in South Africa, when we look at our central bank as well, we've got an unpredictable event that we're going to schedule, which is the election. So that's certainly going to play into the way these guys think before they start to the decreasing cycle. And I think it's probably better or more conservative to say, look, we're probably going to be where we are with rates at the best for a longer period of time, instead of being very, very bullish and saying, well, they're all coming down. That will surprise me.
So those risky events, something to keep an eye out for. Caroline, before I let you go, what's your stock pick?
Well, I'm going to pick Louis Vuitton, and in all cycles, the rich still stay rich. We saw that with Richemont's results. Some are coming out with very, very good sales over the last period. Louis Vuitton, very, very good basket of goods, exceptionally well managed. It did quite badly last year, with the worries about the slowdown in China, which is not going away, but I do think it's factored in the price, and it's probably as nice a time and nicer price at any point now to actually start to acquire those for your long-term portfolio, because the rich are not going away.
Caroline, we have to leave it there. Thanks so much for joining us today. That was Caroline Cremen from Adviceworx.